In May 2026, something happened in the European car market that has never happened before. Chinese brands outsold Japanese brands, not just in electric cars, across the whole market. 12.0% against 11.3%. And they did it while paying import tariffs of up to 45%. Welcome back to the European Investor, where we explain investing in Europe simply. Before we go further, this video is education only. It is not financial advice. And nothing here is a recommendation to buy or sell any share. Always do your own research. Today we follow that one number because it explains far more than cars. It explains what has been happening to European industry for a decade, and it explains something sitting inside almost every European fund you can buy. Here is the number in full. Across 31 European countries in May, 5 Chinese car makers, BYD, Geely, SAIC, Chery and Leapmotor, registered 138,410 vehicles. That is up 65% in 1 year. Japanese brands, which have sold in Europe for half a century, came second. What makes this remarkable is that Europe built a wall specifically to stop it. Since late 2024, Chinese-built electric cars pay extra duties on top of the normal 10%. BYD carries a combined 27%. Geely 28.8%, SAIC the heaviest 45.3%. The share still went up. The reason the wall did not work is simple arithmetic. Even after paying those duties, battery electric cars from Chinese brands still sell about 21% cheaper than the equivalent from a European manufacturer. A tariff only protects you if it closes the gap. This one narrowed it. It did not close it. There is a second reason. The tariff was written for battery electric vehicles specifically, so Chinese manufacturers pivoted to plug-in hybrids, which sit outside it entirely. Pure electric share from Chinese brands plateaued after the duties landed. Plug-in hybrid share kept climbing. The wall had a door in it, and they walked through. Look at one company to feel the scale. Between January and May, BYD registered 135,307 vehicles across the European Union, the Free Trade Area and the United Kingdom. It more than doubled its battery electric imports into the bloc. Chinese brands took 14.2% of Western Europe's battery electric sales. Now, why did Japanese brands get overtaken before European ones? Because Japan had already been losing this fight somewhere else for 4 years in a market most European investors never look at. Southeast Asia was Japan's fortress. It is where the empire cracked first, and it is the preview of what arrives here. In Indonesia, about 30% of the Southeast Asian car market, Japanese brands held over 90% of sales. That fell below 90 in 2024, then to 82.9% for the first 10 months of 2025. In Thailand, 9 Japanese makers together are down to 69.8%. The electric numbers are starker. Chinese brands hold roughly 80% of Thailand's electric vehicle market. And in Indonesia, the industry association's 10 best-selling electric models in March 2025 were all Chinese. Not one Japanese model made the list. In the region Japan built, Japan is now absent from the growth segment. This is the stage that matters for investors because it is hard to reverse. Honda stopped building vehicles at its Ayutthaya plant in Thailand in 2025 and consolidated into a single site at Prachinburi. Its Thai vehicle capacity roughly halved from about 270,000 units a year to around 140,000. Lost share becomes closed capacity. Japan also lost the home market of its rival. Electric and plug-in models passed 61% of new sales in China, and petrol sales collapsed underneath them. Toyota and Honda built the world's best combustion engines and hybrids, and the market they were selling into simply stopped being the market that was growing. Here is the question that actually matters for your portfolio. Is this cheap labor, or is it something a European company cannot copy? The honest answer is the second one. 3 things drive it, and none of them is wages. Vertical integration, development speed, and an overcapacity problem so large it has become a weapon. First, they own their supply chains. BYD makes its own batteries, its own semiconductors, much of its own software. Combined with China's supplier ecosystem, analysts put the cost advantage at 20 to 30% before a single car is shipped. A European maker buying those parts from suppliers cannot design that gap away. Second, speed. Chinese manufacturers develop a new model in roughly half the time legacy automakers take. In an industry where the technology now changes on a software timetable rather than an engine timetable, doing 2 product cycles while your competitor does one is not a small edge. It compounds model after model. Third, and this is the one nobody planned, China's factories can build about 55.5 million vehicles a year. Domestic demand is around 23 million. That is roughly 50% capacity utilization. 30 million vehicles of unused capacity has to go somewhere, and price is the tool for moving it. So, a price war broke out at home. Average discounts on BYD models hit a record 10% in March 2026. Beijing responded in February by banning sales below manufacturing cost. That did not end the fight, it exported it. China shipped a record 540,000 cars in a single month, July. Which brings the story to the companies actually inside your European fund. The pressure arrived from 2 directions at once. Chinese brands taking share here, and European brands losing their most profitable market there. The second one is doing more damage, and it shows up in a single quarter's figures. In the second quarter of 2026, Volkswagen, Mercedes-Benz, BMW and Porsche each reported China sales down between 30 and 41% against a year earlier. For the first half, every one of them was down more than 20%. Volkswagen's China deliveries fell 36.6% to 424,300 vehicles. Markets priced it, and quickly. The Stocks Europe 600 Autos and Parts Index was down about 16% for the year through August, against a broad market that was rising over the same stretch. Porsche was down roughly 27.6%. Stellantis, roughly 48.7%, close to half its value in 8 months. That is not a wobble in the cycle, that is investors repricing what these businesses are worth. Now here is the part most people miss, and it is the actual investing lesson. While the auto sector fell 16%, the Stocks Europe 600 itself hit a record high in early August. The index absorbed a sector in a structural crisis and still made a new peak. That is diversification doing its job quietly. Cars are one instance of a broader European pattern. Mario Draghi's competitiveness report counted 4 European companies in the world's top 50 technology firms against 36 American ones and put Europe's annual investment shortfall at 800 billion euros. Autos are where that gap became visible on a sales chart first. Be fair to the other argument because it exists. Bank of America expects European emissions rules to ease through this year, which would relieve real cost pressure. And several economists argue Europe's measured gap against America is partly a statistics problem. A cheap sector with easing regulation is exactly where recoveries start. So what do you do with this? Nothing dramatic. Open your European or World Funds fact sheet and find the auto sector weight, then the single company weights. If you also hold a German or a European value fund, check whether you own the same 3 car makers 3 times over. Concentration you did not choose is the risk. To recap, Chinese brands passed Japanese brands in Europe in May through a 45% tariff on a 21% price advantage built from vertical integration and speed. Japan lost Southeast Asia first, Germany is losing China now, and a diversified index absorbed all of it. Next week, we look at what the euro's move means for a global ETF held in euros. If this was useful, subscribe. Investing in Europe, explained simply.